The job description of a credit officer centers on evaluating loan applications, assessing the creditworthiness of individuals or businesses, and ensuring that lending decisions align with institutional policies and risk management standards. Credit officers work primarily in banks, microfinance institutions, credit unions, and other financial organizations where credit services are offered. Their role is critical in maintaining the financial stability of these institutions by making informed decisions that balance profitability with responsible lending. Credit officers act as gatekeepers in the lending process. They gather relevant financial information, conduct risk assessments, and determine whether applicants qualify for credit. They also recommend loan amounts, set repayment terms, and monitor ongoing credit accounts to detect early warning signs of default. Because their decisions have long-term financial implications for both the lender and the borrower, a deep understanding of financial principles, analytical thinking, and sound judgment are essential. Depending on the organization, a credit officer may focus on personal loans, mortgages, small business financing, or corporate credit portfolios. Regardless of the specialization, their main objective is to ensure that credit is extended to reliable borrowers and that risk exposure remains within acceptable limits. This involves careful documentation, ongoing client evaluation, and adherence to regulatory guidelines. Primary responsibilities of a credit officer. The primary responsibility of a credit officer is to analyze credit applications in detail. This begins with gathering key documentation such as income statements, tax returns, credit histories, employment details, and business plans, in the case of commercial loans. By reviewing this information, the credit officer gains insight into the applicant's financial status and repayment capacity. Credit officers then use established models or tools, such as credit scoring systems, debt-to-income ratios, or risk assessment matrices, to evaluate each application. They identify potential red flags such as past defaults, low income, irregular employment, or high debt loads. Based on these findings, they decide whether to approve, modify, or decline the loan request. Another important responsibility is verifying the authenticity of submitted documents. This often involves liaising with external agencies, employers, or internal verification teams. Inaccuracies or fraudulent information must be flagged immediately to prevent risky lending. Credit officers also draft or review loan agreements, ensuring that terms and conditions are clearly defined and legally compliant. These documents outline interest rates, repayment schedules, collateral, if any, and penalties for default. In some organizations, credit officers explain these terms directly to clients to ensure transparency and understanding. Monitoring is a key ongoing task. Once a loan is disbursed, credit officers are expected to track repayments, review account activity, and intervene when early signs of delinquency appear. They may also assist in restructuring loans for clients facing genuine difficulties, provided it aligns with institutional policies. Risk management plays a central role in this job. Credit officers are expected to maintain a healthy loan portfolio by minimizing non-performing assets, NPAs, and adhering to credit limits. They must also prepare regular reports and summaries for senior management, detailing portfolio health, trends, and recommendations. It is at this point that the job description of a credit officer reveals its dual nature. It demands technical financial expertise as well as interpersonal skills to engage with clients, explain decisions, and build trust in lending relationships. Essential skills and qualities for the role. Analytical thinking is perhaps the most crucial skill for a credit officer. Evaluating large volumes of financial data and identifying patterns of risk or opportunity requires a sharp, detail-oriented mind. Small errors in judgment can result in financial losses or missed business opportunities. Decision-making skills are closely tied to this. Credit officers often operate with a level of independence, especially in routine or low-risk cases. They must be confident in making timely and fair decisions based on available evidence, while also knowing when to escalate complex or borderline cases to senior authorities. Communication skills are essential for interacting with clients, explaining credit terms, and conveying decisions, especially when rejecting applications or negotiating new terms. Clear, respectful communication helps build trust and manage expectations. Financial literacy is fundamental. Credit officers must understand interest calculations, financial statements, credit ratios, and risk indicators. Familiarity with financial regulations, banking procedures, and compliance standards ensures they stay within legal and organizational guidelines. Proficiency in software tools is important. Credit officers use loan management systems, spreadsheets, credit scoring tools, and accounting platforms regularly. Efficiency and accuracy in data entry and reporting enhance their productivity. Integrity and discretion are non-negotiable traits. Credit officers handle sensitive financial data and must uphold confidentiality at all times. They are also expected to act impartially, avoiding conflicts of interest and following ethical lending practices. Time management is key, especially when handling multiple applications or meeting monthly lending targets. Prioritizing tasks, staying organized, and working under pressure are necessary to succeed in this demanding role. Work environment and common challenges. The typical work environment of a credit officer is an office setting within a financial institution, although those working in microfinance or rural banking may spend time in the field visiting clients or businesses. A standard workday involves reviewing applications, conducting interviews or calls with applicants, and coordinating with other departments such as risk, legal, or collections. Challenges in this role often stem from tight deadlines, changing regulations, and pressure to meet lending targets while maintaining portfolio quality. Balancing customer satisfaction with risk management is an ongoing dilemma. Denying credit to a persistent applicant or managing a client facing financial distress can be emotionally taxing. Another challenge lies in economic fluctuations. During downturns or unstable market conditions, the risk of default increases, and credit officers must adjust their evaluations accordingly. Continuous learning and adaptability are essential to remain effective during such times. Despite these challenges, many credit officers find the role fulfilling. It offers a chance to impact people's lives by helping them access funding for homes, education, or business ventures, while also contributing to the financial strength of the organization. Educational requirements and training. Most credit officer roles require a bachelor's degree in finance, accounting, economics, business administration, or a related field. In specialized roles, such as corporate lending or investment credit, advanced qualifications or certifications may be preferred. On-the-job training is common and covers internal credit policies, risk assessment techniques, regulatory compliance, and software tools. New hires often shadow experienced officers or participate in simulated credit evaluations. Certifications in credit analysis, financial modeling, or banking, e.g., from CFA Institute, ICFAI, or similar bodies, can enhance career prospects. Strong mathematical and analytical coursework also provides a strong foundation for this role. Conclusion. The job description of a credit officer illustrates a role that balances technical expertise with sound judgment and client engagement. These professionals play a vital role in evaluating and managing lending risks, ensuring that financial institutions operate sustainably and customers receive fair access to credit. For individuals with an analytical mindset, attention to detail, and a commitment to ethical finance, this career path offers growth, stability, and the satisfaction of playing a pivotal role in responsible economic development.